Good evening, everyone. Time for another silver update. This is the weekly chart of gold provided by netdania.com. You can click on the link below. The two major trend lines I have drawn here are the uptrend line, long term, cut off some of the financial crisis in the bottom to get touch points, and then the lower line is the MACD. Now you can see we've hit negative 60 on the MACD. It's not that the price is still falling, but because it's such a wide view, it's averaging out before it bounces. You can see it's rounding up. So it's clearly, if we draw the line in all the way back historically, you can see that we are clearly at the lowest level, the most oversold by far in the history of the last 13 years, 15 years, 17 years, you do the math. So very, very oversold condition in gold. I expect silver to follow. Now, the last time we had an oversold condition that was comparable to this, not as extreme but comparable, was the 2008 financial crisis. Now, you know that the top was hit with the Bear Stearns top, so that the top coincided with the beginning of the financial crisis. Of course, there were some tremors, I would say, in late 2007. December 2007 was the official beginning of the recession, according to some economists. So, from that high that we had in March, we went through the summer, and by the fall, we were in the midst of the financial crisis that required massive bailouts and massive changes in everything. So that was about a 6-7 month period, really only about a 5-month period, 4 or 5 month period, before the market started to decline precipitously. So if we look at the one we're in right now, if we measure from the September top, we're talking to this point a significantly longer period of time. And will we see a significantly larger magnitude of financial crisis? I don't know. That's anyone's guess. But we appear to be twice as far into this, and we haven't yet seen the financial crisis emerge. And we're going to look at that sort of issue when we look at some of the difficult questions we're going to talk about. It's going to be the main topic that we're going to get to tonight. But before we do that, let's take a look at the Japanese yen. Now, it has been on an absolute tear, and you can see it's pulling back a little bit, but it touched the 102 level, and that's very significant because it has crossed through 100. Basically, that means that the yen is worth a penny, and you can see that it was worth substantially more, a move from roughly 76 to 101. So that's 33% move. That's an enormous move. And if you remember, at the time I was covering the Fukushima move, which was a dramatic move, and then central bank interventions. But compared to the Fukushima low and intervention, this is a whole different order of magnitude. And so the Japanese are embarking on, I would guess, maybe some kind of last-ditch effort to print their way out of this mess. Now, we know that the Nikkei has responded to that, and it's starting to look something like the Zimbabwe stock market experience. You can see the spike in the Nikkei. Let's go out to the weekly. A very, very dramatic spike in the Nikkei, and only rivaled by the run that we had from the bottom in 2003 to nearly 19,000. So it nearly doubled once before, and then, of course, with the financial crisis, it was cut in half. So a very dramatic run as the Japanese attempt to save their economy by printing money. Do I think they'll succeed? No, I don't think they'll succeed. And I don't think that they're in a situation where they can print their way out of it. Remember that if you weaken your currency, that does make your imports or your exports more competitive, but also means your imports are more expensive. And due to the simple fact that the Japanese are pretty much sitting on a rock, they have to import a whole lot and they have to export a whole lot to maintain their standard of living. And will the imports price increases be able to offset the added sales that they get? Well, I guess the productivity is going to have to make up the difference. We'll have to wait and see on that one. So before we get to the main difficult questions of the night, I wanted to take you over to the blog. Now, I don't know if you've been following it, but we've come under DDoS attacks, we've come under hack attacks, we've come under a lot of attacks, and I just want to thank all the people who've supported us. It's been a monumental effort. There's a malware icon here. We also came under malware attacks. So it's a very difficult struggle. Now, I know there's a lot of people who think that I've received criticism, comment, and feedback from people who think that we're getting richer. I can most assuredly let you know that we are not. And so my wife and I pretty much work on this blog and our other blog full time, and I don't even know how to calculate it. Probably an honest calculation would be that we make about $2 an hour each. That would be my honest guess. So obviously we're not getting rich off of this. I'm surprised that people think that, but we do appreciate the people who have donated via PayPal and also who have donated via Bitcoin. There are also a lot of advertisers on here, and you can support the advertisers. That would help us a lot. I don't like the subscription model, and I don't like a lot of the other models, but we may be forced to go with one of those models in the future just due to the cost. Now, this is my Rackspace account. You can see that the attacks cause the computer cycles to increase. We have a certain set amount of bandwidth, computer cycles, and disk space isn't really important. But these two, bandwidth and computer cycles, those are allocated to a certain amount. If we go over those, then we pay significantly more for hosting. Our hosting is already on Rackspace, which is very, very reliable. I like it. It's in the cloud, but consequently it's much more expensive than having some type of box sitting at some little hosting company. So it isn't cheap, and the DDoS attacks make it that much more expensive. So again, we really appreciate the support, and hopefully we don't have to look to go to some alternative model in the future. Now let's get over to the questions, the difficult questions. We're going to take a few of these. Let's start off with Bob in Montreal, and this is about hedge funds. Hello, Brother John. I'm a follower of your channel for a couple of years now. I want to thank you for your insights. A question that is presently puzzling me is why hedge funds have abandoned their supportive position toward gold and silver as banks and other institutions are quietly adding to their position. Thanks, Bob in Montreal. Well, hedge funds today are not what they have been in the past. For those of you who don't know, just a basic primer of it, hedge funds are funds that are not subject to the same type of regulations that other investment funds, advisors, mutual funds. They're basically investment vehicles for the wealthy, not necessarily for the super wealthy, but for the wealthy. The idea behind it being that to be classified as a hedge fund, you have to be able to allow in people who are wealthy. It's not for people who aren't extremely wealthy. And the reasoning behind it is that people who are wealthy are able to take on more risk and also should be more intelligent, or at least should have done more due diligence when they're investing, and therefore the restrictions aren't so great. At least that's the stated reason. Now, we know there's a lot of other things going on behind the scenes. So when you're talking about hedge fund structures, you're talking about it used to be traditionally that you were rewarded for performance. So it was your standard capitalist model of we get paid when you get paid. So a lot of hedge fund managers will charge a nominal management fee, but the primary fee is going to be based on performance. So the classic hedge fund managers, in my mind, were Jimmy Rogers and George Soros running Quantum Fund. It was a classic hedge fund. The other thing you have to understand is that hedge funds often are more skewed towards hedge positions, which means that they're both long and short. Traditional investments are usually always long, and that's a bias that tends to skew performance for the public, which means that the public wins in bull markets and loses in bear markets. Hedge funds, on the other hand, can often make some of their best gains in bear markets because they're allowed to play both sides. Now, that's the difference between hedge funds and traditional investment funds. Now, as to why hedge funds are underperforming the market, and that's been a common story, you can find it on Zero Hedge or anywhere else out in the news. Pretty much hedge funds are now underperforming the basic S&P index. I think the reason for that is because the markets are rigged. So it's very, very difficult to make money in a fundamental position when the other side of the trade is a central bank. When the other side of the bet is a person who has the ability to cheat. That makes it very, very difficult to make a decision as to what to do. You may have a fundamental view on the Japanese yen, but if you're fighting against the Bank of Japan, you're going to lose. You may have a fundamental view on the value of the dollar going forward or the bond market. A lot of people think that the U.S. bonds are in a bubble, and traditionally hedge funds had been known for shorting bonds when they saw the economic factors lining up for a bear market or pullback in the bond market. But of course, that's not happening now because the Federal Reserve is printing money to buy bonds. So it becomes very difficult to operate a hedge fund in a market that is rigged. And we are in a scenario now where many, many markets are rigged, and that includes gold and silver. Now, as to why the hedge funds have not gone ahead and fought a battle against the central banks using gold and silver, that I don't know. The only guess I could make is that they're probably thinking that if they won, they would change the rules on them. And I think the Hunt brothers have proven that. But definitely in the case of silver, we already know the fundamentals. We know that if any hedge funds or group of hedge funds decided to take the silver battle to the central banks, they could win hands down. It would take a very small amount of billions of dollars to suck up all the physical silver and to bankrupt both the COMEX and the LBMA, and to cause a skyrocketing price of physical silver. Definitely the hedge funds have the power to do that, but also I believe definitely they're afraid to do that because the other side is the central banks. Next question. Interest rates help, please. And this is from Diashin. Hey, Brother John F., do you think Helicopter Bernanke Inc. is hoarding U.S. dollars, and when he hits the mark, he will raise rates to stupid high levels, making everyone in debt, underwater, and bankrupt, thus leaving him and his rich friends even richer, as dollars will be king in that environment? Or do you think when they raise rates, the dollar will buckle and fall? Explain, please. Thanks in advance. Well, that's another difficult question. Now, there's a couple of misconceptions here. first one I would say is leaving his rich friends and him king in that environment. Well, they already are king because they can print up as many dollars as they want and they can buy up everything that exists. We're already looking at a situation where they can buy up all the mortgages and are beginning to buy up all the mortgages. So it doesn't seem to me to be an issue of them trying to have more money. They have all the money. It's more an issue of them trying to keep everything going without it falling apart. So I don't think, and again, this idea of a shortage of dollars, that doesn't make any sense to me. There's definitely not a shortage of dollars. There is an attempt to not hoard the dollars, but a better term I would use would be corral the dollars. So they're trying to corral the dollars into the banks that aren't going to release them into the wider economy. Of course, that's a very difficult thing to do because it tends to slip out. But as far as the issue of raising rates, now a lot of people have brought that up, whether Bernanke at some point is going to try to pull a Volcker. Now maybe the next person is going to, but Bernanke's on his way out. I think Bernanke is just trying to keep 50 million balls up in the air, juggled before they all come falling down. Hopefully not on his watch, because that's pretty much the game that they're all playing, is not on my watch. And now the next one could be a Paul Volcker type, but then again, we have to look at the national debt. So if you remember, fairly recently I covered the national debt and the gross domestic product. And it was just last year that the national debt crossed the gross domestic product. So that was when we crossed over the 1-to-1 or 100% GDP debt ratio. Now you can see we're at 15.7 trillion GDP and 16.8 trillion national debt. We're adding 1+ trillion every single year due to this budget deficit. So this number is quite prohibitive as far as policy goes about how high they can raise interest rates. If you think about traditional interest rates, just on this debt alone, you can imagine that 10%, now 10% is actually half of the high that interest rates went under Volcker. But even if we looked at a 10% interest rate, now that's not normal. I think a normal historical interest rate is 6 and 7%, but 10% historically is by no means unusual. So if we were looking at a 10% interest rate, we're looking at $1.6 trillion worth of interest on this debt. Now you can see this figure here of federal tax revenues is 2.5 trillion. So that would mean that nearly 2/3 or so of the entire tax revenues would go just towards payment of interest on that debt. So it is not, in my opinion, a possible alternative at this point in time to do the Volcker situation to try to drive up the value of the dollar by raising interest rates. We're in a much worse situation this time around than we were that time around. And the next question is Slarty Bartfast, and we'll make this the last one of the night because this is a fairly long question, and it is, you couldn't be more wrong. Hi, Brother John. I have the greatest respect for your work, so please don't take this as other than constructive criticism. But in your recent YouTube, you concluded that the powers that be intend to crash the world economy. I'm sorry to disagree, but you couldn't be more wrong about that. I point this out not to be disagreeable, but rather because I've heard that viewpoint far too often and is simply incorrect and even dangerous. Yes, dangerous because it will lead people to waste their energy, wealth, preparing for a great global collapse that will never come. To understand our modern dilemma, one need only look to the clear historical example of the Roman Empire. Rome grew to greatness as an economic powerhouse driven by an entirely new concept for the day: freedom. Yes, Rome was based upon the rule of law and a very free society. Honest farmers and artisans formed the backbone of the society. Their armies were used to good purposes: to build roads, to keep them open, to keep them safe for trade. Rome's modus operandi was keep the roads open, trade with everyone. Honest, hard-working free men built Rome to never-before-seen levels of wealth and power. Then the criminal scum infiltrated their government. Julius Caesar showed Rome a new way. He showed them that they could use their great armies to rape and plunder all of their weaker neighbors. He became fabulously wealthy doing so. The armies and spies of Rome were converted from citizen soldiers protecting free commerce to professional standing forces with a new purpose: to steal from the weak and to keep the criminal ruling elite safe. Do you see the parallel to what is going on today with the U.S. intelligence and military forces? Rome rotted from the inside out as honest, hard-working free men were displaced by inefficient but criminally supported slave-based farming and industry. The vast majority of Romans were left without gainful employment. The ruling scum didn't do that because they wanted the population to be dependent. No, they did it because they wanted to own all the productive industry and farms themselves. They wanted to steal everything. The inevitable consequence was that honest people were forced out of the economy. The ruling scum were terrified of this unemployed mob, so they bought them off with corn and circuses. Do you see the parallels to today in welfare and television? The ruling criminal scum in Washington and Wall Street don't want the mob to be dependent on them. No, they're scared to death of the mob turning on them, so they'll handle it the only way criminals know how: with bribes. SSDI is just a bribe to keep the mob quiet for one more day. A society based upon such despotism cannot support itself. Ruinous spending on the military and government bureaucracy dedicated only to the support of the criminal elite scum required massive debasement of the Roman currency. Do you see the clear historic parallels yet? As an honest fellow, you just don't appreciate how the criminal mind operates. Criminals are no less clever, charming, or talented than you or I. No, what separates us from them is they cannot conceive of doing an honest day's work. They can only steal. It's all they can do to get by in life. So they steal and steal and steal like the ravenous sociopathic parasites they are. They apply all their considerable ingenuity, talent, energy every day to stealing more for themselves and keeping what they've stolen. It's all they think about. It's all they can think about. You are correct that the worthless scum that control our beloved country are on a path that is ultimately suicidal for us all, but they are not on that path with the intention of suicide. They're on that path because it's the only one criminals know how to walk. Bernanke, Obama, Draghi, et al. Do not intend to destroy our society. If that was their goal, they could do it in a New York minute. No, they're desperately trying to keep things going in the only way sociopathic criminals know how to keep things going: murder, mayhem, bribery, and above all, more thievery. How will this all end? Look to Rome. Men of good conscience predicted the catastrophic collapse of Roman society endlessly. It was going to be consumed by everything from barbarian hordes to volcanoes and earthquakes sent by the gods. Yet none of that ever happened. Instead, the criminals rode the horse right into the ground. Remember, criminals are smart people too. They are good at protecting their ill-gotten gains. Rome simply declined and declined and declined by measured degrees with agonizing slowness. When the scum could no longer keep it together, they broke it up into smaller, more manageable pieces. When they could no longer maintain any effective military, they morphed their control mechanism from military force to religious persecution. In fact, there are those who believe the last tired vestiges of Roman Empire are still with us today, still hoarding their stolen gold in deep catacombs. So, will there be a great collapse of the Western world economy? I sincerely doubt it. The scum will simply ride this horse into the ground one step at a time. Go out and travel around some. Look at the ports, the cities, the farms, the industry still thriving in this great country. Sick and degraded, yes, but still there, still functional. There is still much, much, much more to steal. The ruling elite scum are nowhere near done with us yet. Their grandchildren will be stealing from our grandchildren 50 years from now in a much degraded but still living shell of what was the United States of America. I wish the news was better, but it has always been and will always be thus. What do we do? That is the question all good people of good conscience must ask themselves every day. Well, that's a fantastic summary, and I'm not really going to counter any of it because it seems to me to be an honest assessment of what's going on. I just would mention that I do see a difference between Rome and the United States. Now, I'm not going to go into biblical prophecy, but if you want to understand those things, you need to read Daniel 2. And after you've done understanding, you've completed Daniel 2, you need to read Daniel 7. But Rome and the comparable empires, which were listed as Babylon, Greece, Medo-Persia, and Rome, were considered to be world empires. The modern day empires that are in Daniel 7, in my opinion, are Russia, Britain, the United States, China, and ultimately a revived Rome. Now, what's the difference between world empires in those days and world empires in these days? Well, I would say that world empires in these days seem to be much more restricted in their power than they were in those days. We see that in a decrease in kingly power that started with Babylon and went down to Rome, going from basically a totalitarian dictatorship in Babylon down to a republic through a democracy. That would be one big difference that I see in those empires. And the other big difference is that the modern empires, the United States, Russia, China, and the EU, seem to be more balanced, and I don't see a dominant force. Definitely the United States at this point is a dominant force, but appears to be on the decline. So I don't agree with the analogy exactly, but it is definitely something to look at and something worth considering. Very, very deep analysis. So back to the gold and silver charts. Let's pull up silver. As we have shown in gold, that we had put in a very, very low MACD, nearing a historical bottom, and one that is indicating a potential financial crisis. We have a parallel one in silver, but a little bit different because we have this visited 3 times. Once the financial crisis in 2008, once the May smackdown, and then now. So will we get this type of bounce? I think we are going to get a bounce from here. I can't see it going much lower. Certainly we could touch that 21 level that marks the Bear Stearns top, but I think from that point on, if we do get that low, then it's going to be off to the races. And we'll talk to you next time.